Organized money.
I have a question about AI, and I always see
You should
lots of,
ask AI about that.
yeah, I'll ask Gemini. The question I have is if there's so much demand for AI, and you always see on CNBC and finance people saying, "Oh, there's so much demand, and we can't keep up." Why don't they charge any money for it? Like, if it's so valuable, why doesn't anybody pay for it? That's what
Right.
feels weird to me about this whole scenario.
Well, and why are businesses not, I mean, you hear a little bit about layoffs and often they're attributed to AI and maybe that's because of AI and maybe not, but it doesn't feel yet, maybe this is coming, but it doesn't feel yet like this mass turnover to let the robots do everything.
Yeah, I mean, you see, like no one ever laid anyone off before ChatGPT. Like
Right.
I think the thing that would convince me that the layoffs were really due to AI is if they said we're laying off a bunch of people and we're reducing prices on the things that we make because we're so much more efficient, right?
Right.
So if there was a pass through to consumers, you
Right.
could like legitimately say, okay, yeah, now whatever it is, like meat packing, they can do it, automate it, and so it's cheaper or whatever. But you're not seeing that.
Or if it was showing up in productivity statistics, things like that. And what this brings up is that there's a lot of hype involved in AI. You see, you talk about CNBC, that's the hype man of capital, basically. And you feel this in terms of investment, you feel this in terms of how the markets are talking about it, but you don't see it in the real world yet. And that's when the hype doesn't match the reality. That's when you get financial bubbles.
Yeah, and I think there's another angle here, which is there's just a lot of distrust. We'll get into that. There's a lot of distrust of elites in general in America, and that has gone into
Yeah.
AI as well. But we have some great people to talk about the problem of an AI bubble. Like we're going to go into detail on what is constituting this boom, why it's so one-sided, what happens if the boom does actually bust, what the signs are to look for to see if there are
Yeah.
red flags, that kind of thing.
And also great stuff about, just what are we building? How is it financed? What does it cost? And what are the discrepancies between the cost and the revenue that could get us into trouble? And so we have two great guests for this. Advait Arun is the Senior Associate for Capital Markets at the Center for Public Enterprise, and he just wrote this really great report with a title that Matt and I are both jealous of. It's called Bubble or Nothing, Data Center Project Finance. So we have Advait on the show, and then also Sarah Meyers West, who is the co-executive director of the AI Now Institute, which is an independent research analyst. And both of them are going to talk about these issues around AI, which is really talking about the entire economy at this point.
Organized money. Thanks for joining us, Sarah Advait.
Thanks for having us. Yeah.
Good to see you.
So, Advait, let's start with you. Are we at a moment where the country's prosperity actually hinges on the success of the AI project, specifically the data center build out?
I think the answer has to be yes. This is the only growth industry in the country. I think the construction of any non-residential fixed structure that's not a data center, that line looks kind of flat, and the trend line for fixed non-residential investment in AI structures is really booming. This is the source. This is the engine of capital investment in the economy. I won't say that I won't claim that it's as dangerous as I think capital investment booms have been in terms of its possible cascading effects. I don't think it's like 2008 in a few key respects, but in terms of just the fact that this is the growth sector of the economy, yeah, we're very exposed.
It feels like we got to this point really, really quickly. That and maybe either Sarah or Advait, whoever wants to take it, just how did we get here where America is now a bet on AI?
Yeah, I mean, I have an opinion on that, which is I think that we have seen, this moment of, a lot of excitement and anxiety about this new generation of AI technologies. I think we've seen a shift where, AI was in previous iterations a little bit more invisible, sort of built into infrastructures. And now there's like an interface that people are directly interacting with, and that's changed the nature of the public conversation. But really what is transformed, the role that AI is playing in our economy right now, is that it's also a sector that's receiving a tremendous amount of support from government players. And that's in the form of, stepping back regulation, certainly in the US, but also in other places around the world, direct sort of procurement and contracting, this, interest in building out sovereign AI. There's sort of a red carpet that's being rolled out for the AI sector that we really have not seen comparably within the tech industry historically. And that's playing a big role in boosting what we're seeing in the market.
Yeah, I think that picture is generally really accurate. I think when we talk about what artificial intelligence might have been before 2022, when ChatGPT 3 came out, we actually had a lot of machine learning algorithms integrated into a lot of our financial softwares, a lot of our information processing environment. And the current iteration of what's really popular in the artificial intelligence space, which is large language models, I think that was what really prompted policymakers to think seriously about the potential knock-on effects of this technology all across industry, service industries in particular. And I think we can't ignore the psychology of this boom. I think that's a really key part of it. I think the fact that now that ChatGPT, Claude, Perplexity, these actual inference services allow us to communicate or actually have some experience of communication with these models. I think this is what's really prompting so much attention that we're paying to the sector as opposed to previously.
So is AI profitable? I mean, there are lots of different parts of AI, lots of different AI businesses, but is this sector making money?
The answer is no. I think there's some recent reports from JP Morgan, from folks at Sequoia Capital, where I think there's something between 600 to 700 billion dollars of revenue that the industry needs to earn in order to be profitable, or rather even just to pay back its capital expenditures. And some of my own back of the math, I think, sleuthing on the internet and public filings and public statements suggest that between 2024 and 2025, I think Amazon, Meta, Alphabet or Google, and Microsoft, the big four in this space, they've made about $35 billion in reported revenue from AI, but they've spent over $560 billion on the technology. And it's a little hard to get a precise
But that's
sense of these
more,
numbers.
Right? Like the 560 is more
Yes.
than 35.
Yes,
Okay,
560 is
sorry.
a bigger number than 35.
I'm not a math
Yeah,
guy.
some of the newer hyperscaler, I mean, maybe numbers that are smaller but are actually bigger will do the trick. XAI, which is the hyperscaler set up by Elon Musk, is spending perhaps like $1 billion per month and might only earn about $500 million this year. That is an incredible level of cash burn that I don't think we see in any other industry, even previously in the tech industry, when giants like Uber and Amazon were spending and not covering their costs in order to, I think, expand market share. This is a different degree.
Now, I guess the response to that would be, yes, we've never seen this kind of burn rate, but we've never seen this kind of opportunity, right? That's what the companies would say, that the usefulness of this product will grow, it will take over more and more tasks, and revenue will soar as usage soars, and that will pay off the tremendous amount of money that is being spent right now. But and Sarah, the question is, are there really signs that that's going to happen? Is usage and revenue going to grow? There's an Economist piece just recently that said, investors, this is what they're looking for, and they're not quite seeing it yet.
I think that's right. I think it's worth playing out, both scenarios. So what does the scenario look like if AI as a sector is wildly successful? Like, what's the vision here if it works out? It's a vision of, mass displacement and people being out of jobs. And so is that a vision that we should all
That's
be
the
excited
win.
by?
This is the
That's
win
the win, right?
scenario.
Right. It's
Yeah.
sort of, it is the supplantation of like the rest of our productive economy for the sake of this one sector, which, profoundly benefits, only a few companies, because we haven't gotten into it yet, but there's a huge amount of vertical integration happening
Right.
within the sector, and like, really run by a few billionaires. So that's the win. The loss, and I think it's, a very likely scenario, is that AI is, it has certain capabilities that are, novel and useful, and we don't have to deny that that's the case, to be able to say that the underlying, is this going to be our moonshot, so far isn't really playing out. And it's one thing when it's, in investment firms that are making those kinds of risky bets. I think it's a whole different ballgame when it's, the government that's really backing and trying to bail out in industry, and undermining the broader public in the process.
I want to take us in a slightly different direction, because there's a lot of like, oh, this is a bubble, like it's a problem, blah blah blah. But do you like? I use AI, right? I like AI. My brother sends me like videos, like making fun of people we know, like manipulated, and I watch like AI nonsense on YouTube, and like I use AI in various ways to cut corners. Um, do you guys use AI? Like, and what do you use it for? Like, how are you contributing to this bubble? Be good Americans. I want to know.
He wants to implicate you.
Yes.
So I use it occasionally. I mean, I think it's fun to like play around with and like
Boo!
get the summaries or things like that. I think probably the thing that's tricky here is that a lot of the like idealized use cases are just not really a good fit for this technology. Like, it's a lot of stuff that relies on AI systems being able to produce factual information, and this stuff hallucinates. So like, do I want my doctor necessarily using it in our like electronic health records where it could just hallucinate medical conditions? Absolutely not. No. Do I want to, have it help me come up with like, if I'm running out of ideas for like bedtime stories to tell my kids at the end of the night, like, great use case. That's really useful because I'm exhausted at the end of the day. So I think there's like a fitness for purpose question in place here too. What is it actually useful for has not been like the front and center part of the conversation that we're having about AI.
Yeah, it's really useful for coding, and especially on my side of things where we're working on financial models, where we do some code work just to like get a sense of, for example, with our contract partners working with state governments on like actual financial tool design. It ends up being really useful for getting into code libraries, understanding what might be important for setting up some of these structures. And I think the reason it does that is because these are like statistical language aggregation models that sort of can understand a code base and a fixed set of language relationships very well. And that's what makes it actually very useful for this. However, I think you can't really get something useful out of it unless you really know what you're trying to get. You need to have actually familiarity with the code base you're working with. You need to have an understanding of what you're trying to get out of it, the kinds of structures, the networks that are involved. Really, it's actually hard to use unless you know what you're doing. And I mean, you could say that about any particular tool, but in this case, that's how it at least works.
I don't even use AI. I don't even have a TV. So there, I just go see indie bands.
My niece is working on her college essays and like writing them, and I was like, that is you. I would totally have cheated with ChatGPT.
Well, the thing
But
is,
she
people were
wasn't.
cheating anyway. They were just using like random contractors
Cutting
in
and
India.
cutting and
That's
pasting.
what Chegg was.
Yeah, but
It
now
was.
it's better. Now we can cheat more in a more awesome ways. All right. Sorry, back.
Yeah, sure. But I mean, you say you have to know what you're doing to get something out of AI. And one thing that actually is fascinating to me is how investors are sort of buying into this blindly. Like it seems like you can become a unicorn company these days by saying something AI, and then venture capitalists will give you $1 billion. Like, are they being rational about AI, or is this? I mean, that's what feels like the sort of gold rush bubble mentality, is that you can just stick the words AI onto something and become this huge company.
I mean, we're starting to see this seem like shakier ground, right? Because a lot of the build out of AI has been funded by like cash on the books from the tech giants. It's like funded by Instagram ads or whatever. And we're now moving into an era where this is starting to be financed by, you know, increasingly complicated debt structures. We're now seeing like credit default swaps now
Yeah.
entering the market again.
Always love to hear
So
that brought up. That's
yeah,
my favorite.
yeah. We're
It's like the housing bubble, but dumber.
yeah.
Sorry.
No, it's okay. This is where I'm gonna to come in and push back a little
Oh,
bit slightly.
oh,
Um,
oh.
the
Good.
there, I
Spicy.
think I agree with Sarah's like general judgment that previously like we saw a lot of cash burn and not as much debt, and I agree that there is a lot more debt coming into the system now. The split here is that a lot of these hyperscaler companies, Facebook or Meta, Google, Amazon, Microsoft, they're earning a ton of money on advertising revenue, which they can plow into AI. This is also what makes it hard to figure out exactly how much they're spending or earning from or on AI because they don't separate those
Right.
two buckets when they're putting out their actual statements. So you kind of have to guess a little bit about
So
the
it's like a
revenue.
really, really, really
Mhm.
rich dude that has the money to waste versus
Yeah,
someone
absolutely.
borrowing it. Right.
But
Yeah,
they
and that
don't want to waste it. I mean, one of the things you talk about in your paper, Advait, is
mhm.
that they're not necessarily those big hyperscalers aren't necessarily directly taking that money out of cash flow. They're building these off balance sheet entities because they want to keep their credit rating, I think.
Mhm.
Yep.
So yeah, explain that how these companies have this money, but they're not necessarily directly using it.
Sure. So what the cash flows from all of their advertising businesses can do is that they can start paying off their leases, their rent to these data centers that they're getting other companies to build out. What a company like Facebook does when it's building its Hyperion $30 billion data center in Louisiana is it says, we'll help with the construction, we'll set up the servers, we'll help pay for this, and we're going to pay rent to the eventual owner of this data center, which I think is Crusoe, I think. And Crusoe is the one that actually ends up like it's working with Blue Owl, a private credit
Yeah.
lender. It's working with PIMCO, a bond underwriter. They're the ones actually raising all the debt capital to build that $30 billion center. Meta puts in about, I think, what, $2 billion worth of equity. It's paying the rent, but it doesn't want to have this 30-year long real estate asset on its balance sheet, nor does it want to have a lot of the graphical processing units, the GPUs, on its balance sheet as well, which does have uncertain value. Better to just pay rent, treat it as something that you're, paying for in the short term. It's just a loss on your balance sheet rather than a long-term capital expenditure that might drag your balance sheet down
But
over a longer period of time. Other companies will do the debt. The hyperscalers will just pay the
well,
lease.
do
That's
do
the
we
split.
know the Hyperion? It's called Hyperion, right? They're all
Yeah, that's yeah.
they're all like these Greek names of uh
Colossus.
yeah.
Excelsior.
It's like Lord of the Rings or Greek. Uh
Prometheus. Yeah.
yeah, it would be like nice if one of them just named it like Stan or something like our data center is an $80 billion
Stan's data
thing
center.
called Jerry.
Yeah.
All right. So, but do we know with the Meta Hyperion data center? I read somewhere that like actually the entity that is responsible for it at the end of the day is not Meta. It actually isn't just it's not off balance sheet. It's not even on their balance sheet. It is actually Blue Owl or something like that. But I don't know. Do we know who is actually on the hook for these data centers, even though the hyperscalers are sort of presumably there? Like they're like everyone's looking at it and saying, "Oh, Meta's paying the rent, therefore Meta's kind of responsible." But do we know for sure that they are?
So in a little bit, yes, Meta actually has promised to pay their lease regardless of the revenues they make off of like their AI business.
Okay.
It's a take or pay contract.
Mhm.
So Meta's actually still on the hook for that lease. That being said, right, the data center is I think 20% owned by Meta, 80% owned by Blue Owl. There's a split in the equity ownership of that data center there. And then of course they have all the creditors to pay, and Blue Owl and PIMCO are raising all of that debt on capital markets, and they're going to have to pay back debt over like a 20, 30-year term.
Do you know if they're on the hook for the lease for the full term? I feel like I'm reaching here, but I think I remember it was like a 10-year term and that the lease that the like ultimately there is like a 30-year financing term. So they're not even necessarily promising that they're going to
Mhm.
take care of it over over the long haul.
Please like, subscribe, and hit the notification button so that more people can get exposed to organized money. Really appreciate it.
Yeah, this is something I really want to get into because I mean it's funny. This is supposed to be technology and infrastructure, and really we're talking about real estate. And
Yeah.
and a lot of this is what it's about. But you talk about this mismatch. I think this is crucially important because a data center is a box, and what's in the box is really the valuable thing, and that's these graphic processing units or GPUs. And their shelf life is sort of a contested thing. And you talk about this in your paper that maybe you can use a GPU running hot for 5 years, maybe it's 2 years. We don't really know. And what the companies are saying in terms of how long the shelf life is of these might not correspond to the reality. And that therein lies a big problem because it's one thing to be a tenant of real estate, and it's another thing to have to pay, basically like refurnish your house every few years.
It's that's we actually still don't totally know what the exact useful life of these GPUs are. It actually depends on the demand for the AI inference services that these companies are providing. If demand goes gangbusters, if it continues to rise in the way that proponents claim, you actually might see more technical deterioration, wear and tear of the physical asset itself. But that's not even the most important part of this. If demand doesn't skyrocket, then you have a cash flow problem where now these capital assets you've invested in simply just aren't producing cash flow at the rate that you wanted them to. Now, when NVIDIA and AMD and like chip maker companies are releasing on a yearly schedule, and the hyperscalers are all trying to lock up the best class GPUs as soon as possible, you're in a dynamic where everyone who buys GPUs now is putting themselves at risk of not being able to buy GPUs later. You're spending now. Why spend now if a good one is going to come out in a year? It makes the rest of your assets worthless. Now, I'm saying this is a little bit of an exaggeration, but those are all the dynamics that like come together to make this just kind of a soup of uncertainty. We don't actually know what these capital assets are worth, and yet a lot of the assets that are buying them are borrowing against them in these GPU-backed loan structures. That's tens of billions of dollars worth of loans, and some of them have realized this is a trick to some degree, and they're actually just renting GPUs instead. Oracle's on the hook for buying them, and OpenAI rents from Oracle. Now, OpenAI doesn't have GPU exposure, and everyone is going to try to push that risk backwards onto NVIDIA at some point.
Right.
I have to say, there's something that just doesn't make sense to me about this whole bubble. There's a number of things that don't, I don't know if it's a bubble or not, but one of the things that doesn't make sense is, okay, these guys are always on their earnings announcements being like, demand is like 8,500 times bigger than we ever thought. And like, we thought we'd need to double it tomorrow, but actually we need to double it in the next 5 minutes, whatever it is, right? But they're all losing a ton of money, right? Now, one way in a normal market that you can deal with really, with people wanting something is you could just raise the price, right? Now, if they're all losing money and there's massive demand, why don't they just raise the price? Like, what's going on here?
So, I mean, this goes back to actually, I think, your question about how we actually want to use AI personally and these inference services personally. Would you be sending those videos that you and your family have created if it cost $20 a month or more to actually do that? Probably not. And I think what's happening here is kind of a prisoner's dilemma in pricing, as we've sort of discovered. A lot of these companies providing inference services, the large language models in particular, are offering something that is generally identical. And if it's not identical, it's hard for a user like you or me to differentiate between what model's better, except for maybe like hearsay. In this kind of process, all the companies have an incentive to maximize the market share of their large language model. And they can only really do that by keeping prices low, because if they raise the price, someone else could potentially undercut them. And as the hyperscalers themselves are in a war to maximize their compute capacity, offer the best kind of inference service possible, they just want the most people using their service. They're going to keep the price down. If anyone prices at cost, everyone's going to go to a different service. And part of this is simply because we don't know what the best large language model is yet. Everyone is still dueling it out with these kind of hard to differentiate services. So that's kind of why no one's raising the price. If you raise the price and price at cost, the only people who are really willing to pay for it are maybe like, I don't know, a large bulk order for an enterprise service rather than like you and I making videos or using it for code or something.
Yeah, I mean that you're talking about sort of the consumer facing price. There are other prices in here though. And
That's
that's what
true.
makes this very, very difficult to piece out because like we don't really know what a GPU like actually costs because you're talking about all these rental services or we're funding our own customers and we can get into that. And it's like we know that this build out costs a lot of money, like number big, but like the specifics we don't really have a fully mature understanding of the accounting and what the cost actually is. Yeah, Sarah, go ahead.
Yeah, I mean, I think we got to talk about what the enterprise, corner of the market looks like here too, right? Because, and there was a really good piece in the Financial Times a few weeks ago that was looking at, how are companies in their financial reports that are adopters of AI talking about the impact of AI on their financial risk. And what that sort of account rendered is that there's a lot of clarity coming from enterprises about the risks and the downsides of using AI. Things like, there are tons of cybersecurity vulnerabilities with large language models that cannot be remedied in the foreseeable future. There's a problem with hallucinations. There's, a long laundry list. And the benefits side remains really speculative and hazy. They're not able to very clearly substantiate, we're getting productivity gains, we're getting, gains in efficiency, even like figuring out long-term ways of using the technology. And so I think that's not inconsequential here. They're not raising the price because there isn't a sizable enough enterprise market to be able to justify it. And so, I think that's really important to talk through too, in the places where we're seeing those experiments with AI, what's coming to the fore. Healthcare is one of the places that I've been looking at this the most closely. And, there it's like working in AI systems into, the like ambient listening tools, into like electronic health records systems. And the stuff is just hallucinating. It's actually like nurses are catching that it's making up, people's allergies or missing drug interactions. And there's sort of these fundamental problems that make the technology not work. And it's not really sort of yet bubbled up to like the CEO that's saying we need to be staying on the top of innovation just yet. So really, this seems like we're kind of in a race to the bottom. We got to protect our moat dynamic within the tech firms rather than like we have clarity on what this moonshot looks like.
Yeah. I saw a research study that surveyed, I think it was around coding. They surveyed the coders and they said, oh, we're saving 20% of our time by using AI. And then they looked at the actual the time spent on a particular task, and it was 20% longer. And I think it has to do with having to correct errors or mistakes. And you see these different studies sometimes from the same research institution that that show these different results. And I think that uncertainty is why there isn't sort of an entrenchment yet within enterprise.
I'm a little less skeptical of that. I think there are some very clear use cases in terms of transcriptions and various other things. But your point's well taken. Here's a different question though about I think the incentive structure in the industry, which is one of the things that I think we saw with DeepSeek and some of these Chinese LLMs is, and I don't know if this is the case because I don't know anything, but these are much less efficient. Like, thank you for like the wry smile. I was kidding. I know some things. These
I'm not going to sell you out like that, Matt. I'm not selling you out.
I appreciate it. These are lighter, more efficient large language models. So I read. And one question here is like the hyperscalers are all cloud providers. So they sell compute. And they may not want to, it's like a little bit like their gas guzzlers. They're oil companies that sell oil. So they obviously want gas guzzlers on the road, but they're also the ones developing the cars, right? That's how the industry is structured, because you got the cloud providers that are also generating the models, not necessarily in China, but here. So are we developing a form of AI models that are, particularly inefficient? Is there a real conflict of interest here in the basics of the vertically integrated stack? What is as DeepSeek and all that stuff, is that, I mean, I hear a lot of people say, oh, that's all, not like really it's not more efficient. They just leveraged, U.S. like LLMs or whatever. Like, what's the story with this potential conflict of interest?
So the way that I'll approach that question, I actually think that's a really good like way to start thinking about the problem about like, they're both buying all the compute power and providing the models. And you'll actually notice that companies like Microsoft have started diversifying away from OpenAI. They're working with Anthropic. They're not using NVIDIA. Like people are actually like some of the main cloud compute providers in the space are actually trying to diversify their hardware stack. Google is building its own chips. Amazon is building its own chips. No one necessarily wants to depend on NVIDIA. And there's also the potential for other new hardware side innovations like photonics or quantum computing, depending on what you guys like might think about that. It's possible that those will also really crash the cost of building out these GPU infrastructures. And what that means is if you're doing great on the software side and you can de-risk your exposure to a crash in hardware prices, that's probably really good for you. If you're on the hardware side, you want to make sure you can create new hardware or innovate on your hardware as efficiently as possible to keep up with other improvements. It's notable that I think Google's new model, Gemini 3, was not apparently trained at all on NVIDIA chips. They used entirely Google tensor processing units, they call them. And sort of where this is going, and I can't really speak to the China example, but I do know that like DeepSeek just had a far more efficient use of existing hardware and a bunch of open source model expertise that they put together. It's certainly the case that we might be in, well, what everyone's expecting is that if hardware prices crash, then therefore you might actually see profitability or revenue come into the sector. That's the expectation that a lot of proponents have who are looking forward to hardware side innovation. I don't necessarily know if, like, for example, the oil company analogy is exactly correct on my end, but I do think it's a really good way to look into the sector and say, oh, where can we actually find the cost improvements or the revenue improvements based on what the main actors are doing? You'll notice that companies like Google have the ability to integrate across their whole software because they already own so much of the software that we're using on a day-to-day basis. A company like Microsoft already owns like Azure and its database management software. If it can find ways to integrate AI software into this existing cloud world that it already has control over without actually needing to worry about hardware costs, letting someone else take that problem, that's what those companies will definitely skew towards doing.
Sarah, you were shaking your head about integration and sort of the way these large hyperscalers are vertically integrating across the space. You want to talk about that?
Yeah. I mean, I think that part of the story here is that like the reason why this version of building AI has come into vogue is because it's been shaped by the like incentive structures of these hyperscalers. They're the ones who, if you roll back the clock like 10, 12 years or so, they had amassed like huge pools of data, like massive data sets and cloud infrastructures to be able to process them. And at a moment where like they started to really dominate the field of AI research, all of the like best jobs were working for these AI labs. You saw the rise in dual affiliations for professors at research universities where they work for the university, but they also work for a tech company. They've like shaped this version of AI to fit perfectly within their ecosystems and really sustain and extend them. And I think it's important to play that out because this is not the only way of building AI. I think to Matt's point, like a lot of evidence shows that smaller, highly tailored and structured AI systems work a lot better against certain benchmarks than the large multimodal models. It's just this sort of plays directly into the way that these companies work. But I think it's also worth sort of like thinking through, okay, even if we lived in like the world where we're going for like smaller models and that sort of eclipsed the large giant models, I think there's still reasons to be skeptical that like this is going to produce a world that works for the majority of people more than it does for the hyperscalers, because let's talk about AI agents, for example. That's one of the things that everybody's been very hyped about the potential of. In order for AI agents to work within any given institution, like look at a particular company, they have to be producing a ton of extra data that enables these models to be trained on. And they have to operate very hierarchically in ways that enable more tasks to be delegated to the agent. So like, ironically, we end up with institutional structures that are more highly surveillant and have more top-down control than we would otherwise. Like I think that the sort of the direction that this is
What's like
all
an
leading us
example of
in.
that?
Well, I mean, this is all vaporware right now,
Right.
right?
But
Like we're not like
pretend, like, okay, fake it. It's 5 years from now. We figured out all the problems that we're whining about. There's agents and they work. What is it? What's the more hierarchical world that you're looking at?
so you need to be able to like know that you're able to delegate tasks that an agent is able to take up and run with. You know, if you're, I don't know, if you work in uh like a customer service company, more stuff that can be delegated down to an agent, fewer people that are doing those tasks, and instead people are just monitoring the agents to make sure that they're functioning properly, but at much higher levels of scale. What you've produced is a world in which every level of management has to be like more closely scrutinized, and where there's more top-down control than, you know, if you were able to, you know, actually more freely respond to people and work more creatively.
So I just have
sorry, go ahead.
I want to get to my own bitterness and cynicism, and just general rage about the world.
Again,
Yeah, no, I'm an idiot, but I'm also very angry.
Mhm.
No, so all right, one of the things I think you see in America in general is just there's just a distrust of elites, and that goes to AI too. So, right, so there's just generally people do not think that AI is going to be deployed in a way that will be good for them. That's not the case in other countries. Um, I think that's contributing to this kind of overall vibe that people think this is a bubble and they kind of want it to crash, right? Kind of don't like it. Um, if the bubble does crash, right? I mean, Advait, I know you wrote about this. Like, what does that crash look like? What does it do to the economy? Who gets the like depreciated assets? Like, walk us through a crash.
Sure. So I think first things first, like how this starts, I think we should be paying a little bit less attention to stock market moves on the day to day. Like, I don't actually know what happened this morning. I should check. But what I think is more important is that these contracts, these rental agreements, these leases, those are all going to start the debt, the construction debt for a lot of these data centers. A lot of that is going to come due in the next, I don't know, 2.5 years. I think by 2028, we're going to start seeing some refinancing deadlines loom. And that's, I think, a point where a lot of lenders will say, either I will extend and pretend and just let you off the hook and let you go a little farther with financing, or I
because
want
that
cash.
debt's supposed to get rolled over. Like these are construction loans, and then they
Right.
get
So
rolled
you could
over.
lend to refinancing. And I mean, you
Right.
can lend from that 4 to 6 year construction loan into a 20 to 30 year long-term real estate, like
Got
permanent
it.
loan, but only if the data centers lock down some tenants who are able to pay over that period. And I think if there's a creditworthiness risk at the point of that refinancing, maybe the interest rate is higher over the term than it should be. There's a lot of ways where this doesn't, like where this refinancing doesn't happen perfectly. Um, and it might. I mean, it's just that right now we're very much in the construction phase of these loans, and we're yet to see what the refinancing looks like. So TBD. But that's,
Mm,
I think, a deadline to look out for. One thing that's worth noting is that there are some examples of extending and pretending happening right now. CoreWeave, one of the big neo
Mm.
cloud compute rental companies, what technically default had a technical default on one of its loans, and I think Blackstone let it slide, changed the covenants, let it go. For now, that's what's happening on the lending side. And on the equity side, we're all familiar with the circular financing, the roundabouting, those crazy diagrams where everyone's trying to pay each other in anything except cash. That's the way to read it, basically. The second anyone asks for cash in either side of this, that's when someone has to provide the cash. And we've already established that there isn't currently that much cash available to pay for all of these obligations. When that happens, when you finally see that ask for cash, well, that's when the contracts start failing. No longer are you able to pay your loans to finance your GPUs. No longer are you able to pay your lease for the data center if you're a tenant, hyperscaler tenant, and then the data center developers on the hook for paying back their debt, which they might not be able to do if they have no lease income, especially for data centers that where their lease income is entirely reliant on one tenant, like a Microsoft or a
Right.
Meta. And for the private credit providers, the debt providers in the space, they're exposed to both the tenants buying GPUs and the data center developers owning and building and operating the data center facilities themselves. So they're really exposed on two sides of this. They're not really exposed to NVIDIA, but that's actually the one exposure they don't have in this
Uh,
space.
On this show, when we hear private credit, we say shadow banks. That's what they are.
They are definitely like shadow banks. It's funny. I
Um,
mean, you'll notice that one of the tie-ups, this has been in the news a lot lately, is that private credit and private equity firms are working or buying insurance companies to kind of hold that sort of proxy for a bank deposit.
right.
That's, I mean, there's nothing inherently wrong with this. It makes sense to maximize your net interest margin to make sure you can, borrow short and lend long like a bank might. But obviously, there are actual risks given the lack of transparency, the illiquidity in private credit, and these are things that we just don't have enough. I think we have no insight into as private credit takes the lead role in financing, in providing a lot of the debt financing here. So that's like the mechanics, and then I can talk about what the crash looks like as well.
Yeah, definitely we can get there. But I guess my question is in terms of warning signs, in terms of what we're seeing right now. I mean, it didn't seem good that NVIDIA had to put out a private memo saying, we're not Enron. Like my T-shirt is answering questions brought up by the T-shirt. So, are there things out there,
I didn't eat those
signs,
cookies.
signs of just,
What
yeah,
cookies? I didn't eat
exactly.
them.
What cookies? Um, are there signs of distress that are already out there, or is this more sort of a we don't like how this market is shaping up kind of thing?
For for now, at least, I can't see any evidence that there's actual accounting fraud happening, but there are specious accounting decisions being made that I think we can perhaps disagree over, like how Meta decides to book some of these non-balance sheet assets for the Hyperion data center on its balance sheet or its
Right.
financial statements. You can also look at purchase obligations and cash and the difference between the two. As purchase obligations for these companies start to rise and cash never starts to rise, as accounts receivable start to rise but cash never rises, you can sort of argue that a lot of these companies are doing a lot of things to avoid spending in cash. They're all trying to delay when they need to pay for things. And the longer this goes on, well, the more blinking lights there are. That's what
Right.
I've started to pay a lot more attention to. I can't say there's fraud necessarily, but a lot of people are. I mean, I think a lot of market actors in the space are certainly over their skis with respect to. I mean, it's a very legitimate question to ask. For example, Sam Altman, hey, your revenues don't match your costs. How are you going to make that up? And I mean, we've seen some of the public reactions of people in the AI sector being asked these questions. There aren't really satisfactory answers. And that's, I mean, something very legitimate to ask a company. And for example, I don't think OpenAI CEO succeeded at that.
And I mean, also the emergence of these credit default swaps, Michael Burry's short, like these places where we're seeing people predict and place bets with real money on them that there are going to be defaults coming.
Yeah.
I think that's one other indicator that like within the market, people are increasingly getting a little sketched out about the
Right.
future of
There,
this
there are
industry.
companies like CoreWeave and Oracle, or the credit default swap rates are really, really trending upwards. This isn't a 2008 sign for certain reasons because these are just single corporations and not their particular
Yeah.
projects, but it is a sign that people are betting against the long-term viability of, for example, yeah, CoreWeave and Oracle are the two biggest ones.
How bitter is Elizabeth Holmes right now? Got to be so mad. And like same with Sam Bankman-Fried. Those two are just got to be like, what did we? Why are we the ones?
How are these guys getting away with
Right.
it?
Like, she's like, I had to concoct a whole house of like lies. These guys can just come out and like what? And she'd be so mad.
I mean, like
Okay,
the
so like,
back. I was just
sorry.
the backpedaling on like whether there's a bailout happening too. When like OpenAI had like very clearly in public letters said we want government backing
Right.
for our loans. But just like the integrate, like as soon as the phrase bailout entered the lexicon, they were like, we got
I
to
mean,
get away
the
from this
weird
one.
thing
Well,
is
it entered the
they
lexicon because they said it in
yeah,
interviews. Like it
Right.
wasn't.
You
It
it
you
just
didn't
can't
it
do
didn't
that.
come
Yeah.
out of
Yeah.
nature.
they
But
just
the
Yeah.
like
weird thing is they are there is government backing already, and that can be seen
Yes.
in the ways in which I mean, certainly there's
well, I mean,
regulatory,
there's copyright. Obviously, the copyright thing is the
there's
biggest.
copyright,
They just like took all our stuff, right? I
there's
mean, I don't want to be. I don't want to be like
no, but
saying
in
it's fair
more
use, whatever. But I'm pissed. I had wrote a book. They took it. Like
yeah, I'm
I'm going to
signed
get some
up on
money
the
in the settlement,
Anthropic
but I don't.
settlement.
I want Anthropic to delete their LLM. Like fuck them. I just don't. I didn't
Right.
give them permission. Um,
But even in more fundamental ways, right? And part of it is sort of the regulatory forbearance that we've seen from the federal government, but Also, these local governments are throwing a bunch of money at building these data centers, at attracting data centers that have a very low job impact. And they're kind of leashing their future to this asset performing in ways that it kind of don't make a lot of sense because the cash flow doesn't seem to be robust, especially if you're giving most of it away.
I mean, it's a
So
really unenviable position that local governments have been put in, right? Because they're dealing with budget deficits that were sort of hoisted on them by the disappearance of federal funding. But
Yeah.
they're giving away these tax subsidies to build data centers in their backyards. There are a few states that calculated returns on these taxpayer investments. And what they found is that they're losing between 52 and 70 cents for every single dollar that gets spent on data center sales tax exemptions. So it's a really raw deal.
yeah, one thing I'll note is that a lot of the tax exemptions that states and localities provide to data centers are grandfathered in from small cloud-focused data centers, like the stuff that runs like you
Mm.
purchasing something on Amazon. Like that's the old kind of smaller data center. You could build a lot of them around a city.
Artisanal
They're
data
low
centers.
latency.
Yes.
Not even artisanal. They just
Bespoke.
serve it. They just serve a different purpose. They're for the cloud. They're not
Right. Yeah,
for
sure.
compute or for AI. For example, like AI data centers use GPUs. These old ones are smaller and use CPUs, like normal processors. And where this goes is
And we
we've
think they have a
never.
longer life, right? The
Yeah,
CPU.
yeah. They have a much longer life.
Yeah.
And I mean, I'll talk about the job impact in a second, but like a lot of these older rules for tax breaks for the old cloud-focused data centers have been grandfathered in to deal with these hundreds of megawatts large gigawatt scale projects. And now we don't have them totally built yet, but these rules definitely need an update because otherwise that's quite a lot of sales tax, property tax exemptions you might be providing. And of course, if you're a policymaker in this space, the trade-off is are the, can you offset the losses of these certain property or sales taxes with, for example, sales tax income from the jobs that are remaining in that you get out of the spending? Can you offset that with income taxes? And that's the calculation you need to make. Given that data center construction jobs are maybe 10 times the amount of full-time jobs a data center might hold, especially for these newer ones, well, that's the calculation. And old rules, limited transparency, they're grandfathered in. The calculation being, are these jobs worth the tax benefits they create over the taxes you lose? That's, I think, the schema for evaluating these projects.
So what is okay? So what is the bubble pops? Okay, the warning signs blinking red, stock market goes down, whatever you want to say. What does it look like for the rest of the economy?
So first things first, this is like currently the only quote unquote growth sector that the economy has. So the thing that I'm really worried about, first of all, I mean, the stock market impact is going to be, I think, the one that we all feel most immediately. Like 30% of all of Americans' assets are tied up in the stock market. More so, richer folks have more stuff in the stock market than poorer ones do. So there's going to be a consumption effect across the service economy. And we still don't totally know how insurance money, pension money is tied up in the private credit that is investing in these data centers. And if the private credit goes bust, those sources of capital are already are exposed. So we're probably looking at like a major contraction in Americans' wealth, in potentially consumer spending, and in, for example, regional and commercial banks' liquidity and ability to lend to you, to commercial enterprises around you in your city, because these regional and commercial banks might be investing in some of the mortgage-backed securities and commercial real estate that data centers are backing. So that's, I think, like one part of the market correction, which is on the consumer side and on the banking side. And then the next side is, of course, states and localities that have been banking on these data centers to provide any kind of tax revenue, payments in lieu of taxes, the pilot payments as well. This is supposed to be an engine of jobs, of growth, of bringing construction and service industries to a region. If there actually is a positive promise there of any kind, that may not materialize as data centers in the queue get cut, canceled, or shifted elsewhere. So actually, we're looking at really significant regional impacts across currently what we see as data center clusters. The Northern Virginia, DMV kind of area around New York City, California, the Bay Area in particular, Texas, some parts of the Midwest, in Michigan and Wisconsin. That's where we're going to see a lot of these impacts. And of course, I work on energy finance and some infrastructure work. And I think I'm also, I mean, one of the risks that I really highlighted or wanted to highlight for folks who are reading the report is to energy technologies. I think there's a lot of risk on pinning the future of the American energy system to this one particular growth industry, because there's a lot of promising technology coming out of it. There's a lot of really exciting grid modernization, virtual power plant, demand flexibility technologies, new batteries, better uninterruptible power system management, very interesting stuff coming out of this boom. And some might also argue we're seeing a really resurgence of interest in technologies like nuclear, which could be really important for the American industrial base from here on out. Except there is no industrial base except these data centers. And if this goes, it's not really clear that a lot of will necessarily have a market to sell into. And that's, I think, something that any policymakers really concerned about the viability of the American manufacturing, industrial, energy sectors should be, I think, looking into, because we can't have all of our eggs in one basket in this sense.
Yeah. Another thing that, I mean, I think back to 2008 and what we saw coming out of that bubble crash, and we saw, Bank of America, you got to buy Wachovia, JP Morgan, you got to buy Washington Mutual. There's a consolidating effect as the smaller players in this simply they can't survive, and the ones that have other sources of cash flow take them up. I think that's particularly true in this case where AI performance is so tied to data. We're already hearing stories like Google's Gemini is kind of pulling away because they have a lot of data to train on. So, Sarah, what are the possible impacts in terms of consolidation on the financing getting out of hand and the bubble kind of popping?
Yeah, I mean, I think that that's probably the most likely scenario, whether or not there is a market correction, is we're seeing like a deepened consolidation within the sector already happening. Look at the circular financing deals as a case in point, where, in order for OpenAI to, sort of pursue its path within the sector, which is being the company that builds models at larger and larger and larger scale, it's only able to do this through striking these deals with NVIDIA and with AMD, where the companies that are farther up in the chain are essentially backstopping infrastructure build outs with their own cash on the books. So I think what we're seeing is a deepened consolidation within the sector, a consolidation that is also shaped by policy choices, because we haven't really gotten into this, but the U.S. government in the Export AI executive order has sort of outlined a market shaping role for the government in going and trying to ensure that U.S. made AI is being sold around the world. And in that, they're in the position of essentially picking and choosing winners and losers within the market. The New York Times had a piece just yesterday on David Sachs' role in all of this, where he's, has a huge amount of investment himself in the sector, and is directly involved in brokering deals on behalf of companies like NVIDIA. So I think that there's a very clear hand in the market that's already working in favor of deepened consolidation in what was already a very consolidated market.
Yeah, one thing I'll say is, I mean, the U.S. government has always done commercial diplomacy for a lot of its leading industries. One thing that I fully do not understand, I just don't understand what it means to export AI. No one has ever been able to
Right.
really convincingly explain to me, what exactly are you exporting? Are you exporting a license for someone else to use the technology? Are you helping support the building of data centers abroad? Maybe that's happening in the Middle East with the Stargate project happening there. Are you just like letting OpenAI sell their services at a slightly discounted rate to a company abroad? No one's really been to me. There's a kind of lack of clarity of actually what the commercial business model outside the US actually looks like for US based companies that doesn't involve selling GPUs.
And not
And it
to
might,
mention a lot of the, sorry.
no, you go ahead.
Well, it's just not to mention that a lot of the stuff that we're actually putting into the data centers is imported. So there is that aspect of
Right.
it. But I guess last question for you guys is, okay, there's been a crash. You got these data centers that have defaulted, and there's these GPUs that are sitting there. There's been this wealth contraction. Some of the construction jobs are gone. What do we do? What's the right policy framework?
So on the infrastructure side, and I'll speak to this rather than I think on the AI service side of this thing, but on the infrastructure side, these are gigantic data centers that even if they don't reach a gigawatt, if a market correction happens before that, if they're a little smaller, they still have interconnection rights. That's a place to put energy technologies. It's a place to put new sources of load. And I
Hmm.
think for policymakers concerned about backstopping American service or manufacturing growth that have other industries, for example, manufacturing or metals refining, something that might need to use a lot of energy, but perhaps at a lower price point. The backstop plan that we're thinking up, at least for the energy sector, involves refinancing those interconnection power purchase agreements at a lower price for other kinds of off-takers or even generators to play in that space that is left by a lot of these stranded assets.
See,
For the
I
facilities
thought there were going to be
themselves,
really big laser tag battlescapes. I
I
thought
mean,
that was
look,
a
the
good
American service sector is kind of on its
lead.
last legs. This could save it, I think. Like this could be it.
Okay.
I'd be very excited about that personally. Yeah. I'm very bad at laser tag, but it sounds fun. The
They're
the
like
other thing,
miles long. I mean, think of the possibilities here.
I've heard you're terrible at laser tag. I
Yeah,
really
I've heard
have.
that
So
on the
anyway, sorry,
street.
but
Yeah.
keep
I'm
going. I
sorry.
want to hear. I want to hear the
Try to
rest
be
of
stupid.
before David. After
I'm
David,
sorry to interrupt.
whatever.
no,
You
no, no.
ruined
I think
everything.
I ruined it all.
see, I
You
was
ruined
initially
it.
thinking this would be a manufacturing sector plan, but I guess this plays. I mean, we have a reality TV and a miles long laser tag course. Anyway, where the other part of this kind of backstop plan, I think it would be really useful, especially for the energy technologies that might be perhaps facing a demand shock in the event of a data center market correction. I think federal and state governments should be putting themselves in a position to help support those developers, those technology developers, those licenses for new kinds of technologies, in ways that allow us to perhaps reuse them for other purposes. There's a lot of interesting work being done in the virtual power plant demand flexibility space. Combine that with, I think, a lot of the home electrification, consumer electrification push happening in a lot of states. There's a market there. We just have to make sure that, where data centers are willing to pay unlimited amounts of money for these technologies and other consumers aren't, that, for example, the public sector can step in and create these new markets for actually very useful kinds of technology. And on the consumer protection side, I mean, this is, I think, where we need to really think through the vulnerabilities of private credit. Its tie up with insurance, tie up with private equity,
Mhm.
the lack of transparency. I think we're going to have a financial regulation side to this story as well when we're trying to clear up whatever the outcome of a market correction looks like.
Sarah?
Yeah, I mean, I definitely agree on the financial regulation component. Like, there's a lot of ways that this sector has been incentivized to work in certain ways that are like infusing it with a lot of funny money. And so closing up those loopholes in the way that we're regulating financial institutions that incentivize those kinds of structures, I think is an immediate like place to step in. I think that the second thing is, there's a sense in which, we've placed all of our bets on this one thing. And it's not just like within the tech sector is only kind of focused on one kind of AI. It's really within the wider economy. Like the economy is only being stimulated to work on the development of this one technology. And there's like a lot of hand waving around like, well, AI is going to cure cancer for us. We don't have to like invest in the NIH anymore. Like those kinds of moves. And so I think correcting that, really, reinvesting, developing an industrial policy that is more directly invested in, ensuring that we have universities that are producing basic research that's going to be beneficial for broader society, having the right kinds of market incentives that enable people to build businesses that sort of move from the ground up from real needs in the world, and build there. And then, I got to say, like, there's sort of a whole tech policy playbook that is, ripe for this moment around like rigorous enforcement of antitrust, having a data privacy law that protects people and, ensures that there isn't this massive like collection of people's data for the purpose of training AI models. All of that I think is ripe for this moment to prevent, another, bubble like this emerging again.
Great.
All
Well,
right. So have an industrial policy with different technologies, re-regulate all of finance, and restructure the tech sector with antitrust and consumer. But that seems like a fair,
Easy.
like some sort of deal, like a new deal,
the
of
small
like a deal
deal.
of a small of
It would be great if we like
neo.
started now, even because it's going to take a while.
That is ridiculous. All right, thanks for joining us. We had a great time, and this was super interesting.
Yeah, thank you both so
and,
much.
Yeah,
Appreciate
happy
it.
bubble.
Thanks so much.
Happy bubble.
Have a good one.
Happy bubble to you.
Organized money.
I think I saw an Edelman Trust barometer, which they do sometimes, and I always think, unless you say things I agree with, I'm just going to say that this is corporate hackery. But since it said something that I agreed with, I'm going to use
It's really insightful. Then.
It's really good stuff this time. No, so what they said is that they did all over the world. They did these surveys of what people think of AI, and what they found is that in the U.S. in particular, there was a fear of AI. There was distrust. I mean, Brazil and China and other places, people were like, AI is going to be kind of cool. But in the US, what we found is most people, particularly lower income, but it was across the spectrum, said that they think that AI is going to make their lives worse. Not necessarily that it's a bad technology, but that it's going to be deployed in ways that undermine their leverage as workers, as consumers, whatever. And that is like what we hear. That to me, that's like why this feels like a bubble that everybody wants to see popped, because nobody likes this technology, or at least nobody likes the people deploying.
Yeah,
the
that's it. That's the key. It's not about the technology, I feel like. It's about the people who are selling the technology and directing it. It's about the lineup of people at the inauguration. It's about Elon and Zuckerberg and Sam Altman and the Sundar Pichai and all those guys.
It's the unchastened bankers from 2008 who are now in a party with the unchastened big tech monopolists from 2018, and they're like, "We're going to lay you off and take all your electricity and water."
But even if we're saying we're going to make the world a better place, we're now in a moment in American life where Americans broadly say, we don't believe you. Like, we just don't believe that this is going to be good for us.
They don't really. First, what they say is, this is going to be great. We're going to be able to lay half of you off. And then people are like, I don't like that. They're like, oh, we'll also be able to cure cancer.
They're these are dumber elites that are like it's kind of like in a James Bond movie where the villain tells you exactly everything about the plot before he kills you.
But then he tries to convince you that he's actually, the plot is good for the world.
But it's actually good. But he starts with, what I did was I'm going to actually rule the world, but I'm going to be really benign about it.
I'm going to kill you with a laser. Well, actually, you know what? It's really just like, there's some parts of your body. We're going to do some liposuction. It's going to be great.
And there are really great innovations in laser technology that's enabling me to do this.
I guess so when I was looking at this, I mean, I also think that the AI bubble, like one of the things that I think both of us, you and I both worked on big tech for a long time. And what I found for most of that time is people say, why do you care about Google? Why do you care about these companies? Like, why don't you focus on things people really hate, like their cable company or whatever, whatever company they found in the airlines they found annoying at the time. And that's not true anymore. I think most people have recognized, okay, these big tech companies are no longer, just monopolies that maybe do some cool, search engines or whatever, or 2-day shipping. They're like, oh, this is like America has just like bet on them, and they're people are concerned about.
That's really interesting,
their power.
Because there was this moment where people would point to the Harris poll and they would say, see, the most trusted people in the economy, or the most trusted people in American life, are the military and Amazon. And that's not true anymore. And that's driving a lot of the skepticism, where, Michael Burry coming out and saying this is a bubble would get interest from, the short sellers and a group of fanatics that look at markets. But now it's getting sort of broad take-up. Like, there's rooting for the bubble to crash.
This is the bubble everyone wants to pop. That's the difference here. Is it's like there's this attempt to be like, oh, nobody sees the AI bubble. It's like everybody sees it and we can't stop it. And that's what I think it's like infuriating, because we all know that data centers that's pushing Clippy on everyone that no one is paying for doesn't make any sense. And we want it to be popped, but we're all powerless to pop it. And I think that's like really what is really what's driving a lot of the sentiment here.
Yeah. Well, it was a great discussion. I really feel like I learned a lot, and looking forward to get your feedback. And we will have another episode for you next week on organized money.
Organized money.